Hey there, Wade Betz here over at Guardian Mortgage. Just wanted to thank you for visiting my video blog today. Today's topic is how the new tax laws affect mortgages. So, as you've probably heard by now, the government has passed sweeping legislation that dramatically changes our tax code. And as with all tax topics, let me just start off by saying please consult your own CPA for individualized tax advice. But with that out of the way, the main driver here is that the standard deduction has been increased up to $12,000 for an individual and $24,000 for a couple. Now, this is important because it will encourage more people to claim the standard deduction as opposed to itemizing their deductions, which is where the mortgage interest deduction came into play a lot. So there's basically three big downsides and one positive that went along with this tax plan as it relates to real estate and real estate finance. So the first one is the mortgage interest deduction. Previously, a loan amount up to $1 million could have the mortgage interest written off on that. Now that is lowered to $750,000. So while that still is a very large number, it does affect some people at the upper end of the market. Now, the other thing that's important to know is that equity indebtedness, so that's if you took cash out of your property at some point in the past or plan to in the future. Previously, there was all these complicated rules about what was allowed to be written off and what wasn't. But basically, starting in 2018, none of the interest on the equity piece of that loan is going to allow to be written off. So definitely keep that in mind and definitely talk to your CPA if you have concerns that this affects you. Now, the last piece of this that's kind of bad news is the property tax exemption. You're only going to be allowed to write off up to $10,000 of the property taxes on your property. And while that might sound like a large number, at least in the DFW Metroplex with the tax rates, property tax rates around the 2.5%, 2.7% range, that's not the largest property assessed value that affects you. So definitely keep that in mind. Now, on the plus side of things, the benefit of this is that they were able to keep the existing capital gains exclusion in place. And so what that was saying is that if you're an individual, you can write off up to the $250,000 in capital gains, or if you're a couple, you can write off up to $500,000 in capital gains, assuming that you've lived and occupied the property for 2 of the last 5 years. So this affects, or this is still very good for those customers of mine who like to purchase a property, fix it up, live in it for 2 years, and then go to sell it, make a large capital gain, and then rinse and repeat. So that is a very good way to build net worth that I've helped some clients structure things like that. So that is great news. Now, the thing to keep in mind with all of this is if you have concerns or you want to talk through this with a professional that knows what's going on, please give us a call. We're happy to help. And if you're planning on buying a home in 2018, definitely give us a call. We will take great care of you and help you make an educated decision for you and your family. So again, thank you for visiting my video blog and have a great day. Bye-bye.